Most families think of term life insurance as a single product, a premium, a face amount, a length of years. The decision feels straightforward. Pick the lowest premium for the coverage you need, sign the application, move on. What that framing leaves out is that term insurance is a contract, and contracts vary in how they are written. The two variables most policies are compared on are the monthly premium and the face amount. Those are the two variables on the comparison sheet. Those are the two variables the quote engine returns. They are also the two variables that say the least about how the policy will actually function when accessed. Two policies at the same monthly premium with the same face amount and the same term length can behave very differently inside the contract, depending on which provisions were included and how each provision is written. That difference is not visible at the point of sale. It is visible only in the contract. 6 categories define how the policy behaves. The accelerated death benefit provision. The rider categories included the acceleration percentage cap, the method of benefit reduction, the conversion privilege, the renewability terms. Each of these is written as a separate provision. Each is specified differently across contracts, and each one, taken alone, can be the difference between a policy that responds when accessed and a policy that does not. The accelerated death benefit, often abbreviated ADB, is a contract provision that allows access to a portion of the face amount before death when defined conditions specified in the contract are met. The provision may be included in the base contract. It may be added as a separate rider. The form it takes is a contract specification. 3 rider categories define what triggers acceleration under an accelerated death benefit provision: the terminal illness rider, the chronic illness rider, the critical illness rider. Each is defined separately. Each has its own trigger conditions written into the contract. A terminal illness rider provides accelerated access when a physician certifies a life expectancy of less than a defined number of months. The number is typically 12 or 24, as specified in the contract. A chronic illness rider provides access when the insured is unable to perform a defined number of activities of daily living, typically 2 or more of 6, as specified in the contract, with the inability expected to be permanent or to last a defined period. A critical illness rider provides access upon diagnosis of one of a defined set of conditions listed in the contract, typically including specific cardiovascular events, specific cancer diagnoses, and a small number of other named conditions. The defined set is in the contract. What qualifies and what does not is a matter of contract language, not assumption. When a portion of the face amount is accelerated under any of these riders, the contract reduces the remaining death benefit. The method of reduction is one of 3: lien, discount, dollar for dollar. Each one changes the math differently. Under the lien method, the accelerated amount becomes a lien against the death benefit. It accrues interest at the contract rate. The remaining death benefit at claim is reduced by the lien plus accrued interest. Under the discount method, the insured receives a discounted present value of the accelerated portion. The discount reflects the actual reduction for early access. The death benefit is then reduced by the original accelerated amount, not the discounted amount paid. Under the dollar for dollar method, the death benefit is reduced by the exact amount accelerated. No interest accrues, no discount is applied. The method specified in the contract determines what the family receives at claim, not the rider name. Beyond the rider categories and the reduction methods, 3 contract specifications determine whether the policy actually does what the family thinks it does. The acceleration percentage cap defines the portion of the face amount the contract permits to be accelerated. It is often expressed as a percentage of the face amount with a separate dollar ceiling. 2 contracts may both include a chronic illness rider, but one may cap acceleration at 24% of face amount per year, while another permits a one-time acceleration of up to 75%. 2 policies at the same premium can specify these variables differently. Whether the accelerated benefit provision is included at no additional premium or written as a separate rider with its own cost of insurance, that is a contract specification. The conversion privilege defines the window during which the term policy may be exchanged for a permanent policy without new underwriting. The window is defined in years and sometimes ends before the level term period ends. Renewability defines what happens at the end of the level term period, whether the policy renews on an annual basis at attained age premiums or terminates. A couple looking at an existing term policy can ask 5 questions of the contract itself. The answers are in the contract. 1. Which rider categories are included? 2. The acceleration percentage cap on each. 3. The method by which the remaining death benefit is reduced. 4. Whether each rider carries a separate cost of insurance. 5. The window for conversion privileges and what is preserved in conversion. These 5 questions, asked of any term contract, return a picture of the policy that the comparison sheet does not. Reading the contract is what reveals the policy. A well-designed term policy is one where these structural variables were chosen on purpose, not inherited by default. The premium is the same, the contract is not. The family that understands this is no longer choosing on premium alone. They are choosing on how the policy is built, how it defines access, how it reduces, how it converts, what it preserves. If the policies you put in place years ago no longer match the life you have built, reading what is actually inside the contract is where that conversation begins.